This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The following chapter goes through and looks at the consolidated statement of cash flows. Clearly, it's going to be examined within question number 1 as part of the group accounts and will be there for the standard 35 marks. It's something that gets examined maybe every 2 or 3 sittings, maybe even less frequently than that. So it's not something that appears regularly, but I really want you to promise me now that you're not going to look at what's been recently examined and think, well, maybe there has been a cash flow that's been examined recently, so I'll take the chance and not revise it, and then all of a sudden it crops up within the real exam and you are screwed. Okay, no, you have to practice all the financial statements, position statements, performance statements, so profit or loss and OCI, and this one here. If you don't practice the cash flows, then you are practicing to potentially fail the exam. Go through and have a look at the past exam questions. You will find that even though it's tricky to start off with, it is a perfectly passable, very good area to score marks upon within the exam. Okay, so do go through and put in plenty of effort. So let's go through and have a look at what it's all about. Again, the little bits and pieces in here aren't within your notes until we move into what you see within your notes being the actual group statement of cash flows itself. But that's what we have there, isn't it? We've got your group structure. We've got the parent, the subsidiary, and the associate. The way in which exam questions work and the way in which things work in the real life is, if you think about F7 and your statement of cash flows question, you had the statement of financial position for the current year and the prior year. You then had the statement of profit or loss, and then you had to look at the movement in the various balances, whether that was the working capital balances, property, plant and equipment balances, share capital, share premium balances, debentures or loan balances to work out the inflows and the outflows. When you look at it from a group perspective, it's exactly the same. However, what you get now is a group statement of financial position and a group statement of profit or loss and other comprehensive income. So the basic fundamental principles still hold from what you've seen in F7. The basic exam technique that you have from F7 still holds. However, what we need to go through and do is we need to just look at some additional cash flow items that appear based upon the fact that we are preparing the accounts now for a group, and that is based on the concept of substance over legal form. There are now some additional line items that appear within the SFP and within profit or loss that give rise to additional cash flows that we have not seen previously. So if we look at that group structure there, very simple, with a parent, a subsidiary, and an associate. Let's just think first of all with regards to cash flows between the group and the outside world. That's what you're thinking about when you're preparing your group statement of cash flows. What cash flows arise between the group and those outside of the group? Well, to start off with, we look at things internally, because if S declares a dividend, then P records its share. Now, that's neither an inflow or an outflow within the group accounts. In P's individual accounts, it will be an inflow. In S's individual accounts, it will be an outflow. But within the group accounts, P's share of S's dividend does not exist. However, if S is not a wholly owned subsidiary, then the non-controlling interest will get their share of that dividend. So if that's the case, there is a cash flow between the group and those outside of the group. So here, there will be an outflow based upon the non-controlling interest share of S's dividend. Okay. We then go through and consider what happens if A, the associate, goes through and declares a dividend. Well, if the associate declares a dividend, again, this gives rise now to another cash flow between the group and the outside world, because the associate declares a dividend and P will record its share of that dividend. Now, what we've got to be careful of here is that that is an inflow, isn't it? The dividend paid to the non-controlling interest is an outflow. The dividend received from the associate is an inflow. Okay, so there's the two things, first of all, that we need to go through and consider. We'll then need to consider things a little bit further And what we'll need to consider there is when we look at acquiring or disposing of a subsidiary. Because if we go through and look at that group structure there, what happens if we bring in another subsidiary? If we bring in another subsidiary, there's going to be a big cash outflow, isn't there, as we acquire that subsidiary. But do we make any adjustments for the balances that have come in on consolidation? Because now we are consolidating a new subsidiary and we need to take account of all those balances that have been acquired on acquisition. So there's going to be quite a lot to consider. So just to summarize, the three main areas that we need to consider are the dividend paid to the non-controlling interest, the dividend received from the associate, and then either the acquisition or the disposal of a subsidiary. So they're the three things that we look at in the chapter first, and then we go on to build it up by looking at a full-blown group statement of cash flows example. Before we get into any of those aspects first, let's just have a look at what you've got there within the class notes. Because within the class notes, you should have there right in front of you is a pro forma group statement of cash flows. Learn it. If you don't learn it, you're going to be in trouble. Okay, that's one of the big problems that students have with regards to cash flows. Everybody remembers the position statement. Everybody remembers the performance statement. People struggle when it comes to cash flows. So spend a bit of time revising it. So here we're essentially looking at the investing and the financing activities. Again, if you think about what we've spoken about so far, within your financing activities, you can see the dividend paid to the non-controlling interest. So that there is in brackets, that is an outflow. The dividend received from an associate, remember we said that is an inflow, and that goes there within your investing activities. And then you have the acquisition or the disposal of a subsidiary. If you have the acquisition of a sub, you have paid to bring the sub into your group. So there's a big cash outflow. If you've disposed of a subsidiary and got rid of it, there's going to be a nice big cash inflow as you get the sales proceeds on disposal. Okay, so there's the three main aspects that we've spoken about already. Just to add on top of that, there's some smaller little bits and pieces. If you look at the top of your consolidated statement of cash flows within your operating activities, you will also need to make adjustments for those non-cash items. So you have to prepare the group statement of the group statement of cash flows under the indirect method. So taking your group profit before tax and reconciling it to your cash generated from operations. And we add or deduct those non-cash items. So the common one that you can see at the top is depreciation. So that's a non-cash expense, isn't it? You've charged depreciation, which has reduced your profits, but it is not reducing cash. So therefore, we need to add it back on, don't we? Well, an impairment is exactly the same, isn't it? An impairment of goodwill within a subsidiary is a non-cash expense. So any non-cash expenses, we add them back on, don't we? Okay. Likewise, you've got then following your impairment, is it the gain or loss on sale of a subsidiary? So again, in F7, we adjusted for the profit or loss on disposal of a tangible, so property, plant and equipment. Here, the same principles. We may have a gain or loss on disposal of the subsidiary, so that group profit or loss. It's just an accounting adjustment, isn't it? Accounting for the substance, the fact that we have disposed of a subsidiary. So therefore, the cash element is dealt with as a cash inflow within your investing activities with the disposal of the sub, but you need to adjust for the gain or loss on disposal. So if it's a gain, it's push profits up. We need to remove it, so deduct it. If it is a loss, that's pushed your profits down, so we need to add it back to get to our correct figure. The last figure that you've got there is looking at your share of associates' profits. So remember, you record your equity accounting of your associate in the statement of profit or loss as one line item, isn't it? It's there immediately before PBT. But if we start right at the very top with your group profit before tax, we need to work backwards, don't we, to get to your group operating profit. So the first thing that you go through and see there is the profit of the associate, isn't it? Now, if you've got a profit, that's been added in, so you therefore need to go through, don't you, and deduct that figure. Okay, so you will need to deduct that share of profit of associate to go through there and get you back, is it, to your operating profit. Okay. Once you've done that, that's it. You'll see a lot of the things dotted around are all exactly the same. So gain or loss on disposal of tangibles, interest payable, adjustment, inventory, receivables, payables, interest paid, tax paid. So there is a lot of information that you see that is being done exactly the same from F7. So if you've mastered the technique of cash flows from F7, then you're going to be in a really good position to go through and master the technique further when we apply it to a group statement of cash flows. Our first port of call with regards to group statement of cash flows is going through here and looking at the dividend paid to the non-controlling interest. I'm a little bit old-fashioned, so I prefer to look at the calculations with regards as to using T accounts. You don't have to use T accounts if you don't wish, but if you fail the exam, that's your own fault. Okay, I have no sympathy whatsoever. If things get complicated and difficult within the exam, T accounts will come to your rescue. Trust me. Okay. I know you sat there going, oh, I don't like T accounts, Christopher. Well, tough. Okay. Learn to like them. You are training to be an accountant. Yeah, and T accounts are fundamental. Okay. So what you've got there is, if you think about your dividend paid to your non-controlling interest, it's a dividend paid, so it's a cash outflow, and it goes there within your financing activities within the group statement of cash flows. So when we think about non-controlling interest, the only place that we see non-controlling interest on the SFP is within the equity section, isn't it? So what you have there is that you have your brought forward figure from the SFP on the credit side. So I say SFP meaning group statement of financial position. And then you have your carry forward on the debit side, ready to bring forward on the credit side in the following year. Okay, so that's your opening and closing balances. The profit figure that you have comes from your statement of profit or loss, doesn't it? So when you split out your profit, at the bottom of your statement of profit or loss, you've got your group profit, which is then split attributable to the parent, and the non-controlling interest, isn't it? It's that profit attributable to the non-controlling interest that increases the amount that the non-controlling interest own of the subsidiary, isn't it? So we are crediting that to the non-controlling interest. What you can do then is you can go through there and balance it up, and you will then get your dividend paid. Again, if you think about it, that balancing figure is on the debit side, because essentially what's happening there is that you're crediting your bank and debiting your non-controlling interest, aren't you? Yeah, you're making a payment, you're returning a bit of the subsidiary back to the non-controlling interest. So it makes sense that it is on the debit side, as it is reducing the ownership interest in the non-controlling interest, isn't it? Okay, or at least what the non-controlling interest own. Okay, so credit the bank, debit the non-controlling interest, if you like your journal entries. The only other bit that you need to go through and be careful of is just be aware in the exam when you do a big group statement of cash flows question is that there will be the acquisition of a sub, or there will be the disposal of a subsidiary. Now, if that's the case, what you need to do there is thinking about back to where we started to look at your changes in group structure. If you have the acquisition of a subsidiary, then the non-controlling interest is going to increase, isn't it? Because all of a sudden we've introduced some additional non-controlling interest that previously was not there until we gain control of that subsidiary. So you need to credit the non-controlling interest if there is an acquisition of a sub. If there is a disposal of a sub, then we no longer control the sub. The assets have gone, the liabilities have gone, and also the non-controlling interest have gone. So we need to reduce the non-controlling interest by whatever non-controlling interest was disposed of at the date of disposal. Okay. Again, in the exam, they may give you the non-controlling interest at acquisition or at disposal, or you may be required to calculate it. Again, be aware in the exam, it could be the NCI based on the fair value of the NCI, or the non-controlling interest based on the proportionate share of net assets method. So all that is then doing is starting to test you on your knowledge of the group SFP and working number 4 and how you calculate the non-controlling interest at a particular point in time. That's hard, isn't it? Okay, but let's leave that for the time being. Let's just keep it as simple as possible. Okay, and have a look there at a little example. Okay, in the example, there's no acquisition or disposal of a sub. We'll save that until the bigger example at the end of the session. So here it wants us to work out the dividend paid to the non-controlling interests. The group statement of cash flows, the year ended December 2015. So again, it's important to identify the year end so that you can get the correct opening and closing figures. There's nothing worse in the exam when that happens. Okay, so you've got your opening there 2014 of 110, and your closing is it there of 115. So what we can go through and do is we can draw up my T account. It's there as my non-controlling interest, isn't it? My brought forward was that there as 110 on the credit side. My closing was there as 115 on the debit side. Okay. Once I've got that, I can then go through, can't I, and start to look at the statement of profit or loss. So, you've got this profit figure of 60, but that needs to be split, doesn't it, into the amounts that are attributable to the parent and the amounts that are attributable to the non-controlling interest. So that's what we've gone through and calculated previously by taking the non-controlling interest share of S's profits for the year. It's been done for us. We don't need to calculate it. It's there as 6, isn't it? So we can put in that profit figure there of 6 because that's going to increase the non-controlling interest ownership, isn't it? And then when you balance that off, is it 116 on the right? Is it 116 on the left? When you balance that up, the balancing figure that you have, is it there as 1? That essentially is your entry to the bank because you've credited bank, debited non-controlling interest, and that there is the dividend paid to the non-controlling interest. Again, whereabouts does that go? That's there in your financing activities, isn't it? Okay, there we go, nice and straightforward. Using the T account. If you don't like the T account, I shouldn't really tell you, but it doesn't do us any harm. You can do it maybe in the shortcut method that you did in F7. So you've got 110 as your opening, you add the profit, you deduct your carry forward, which was 115, and that gives you there, is it a balancing figure, which is there your cash figure, isn't it, of 1. Okay, obviously then you can add in any non-controlling interest on acquisition of a sub or deduct the non-controlling interest at disposal of a subsidiary. But personally, as I've said, I'm old-fashioned. I prefer the use of T accounts. I also think it makes it much easier for the markers to understand what you've done, and if they can understand what you've done, they're going to give you more credit if you've gone through there and made a slight mistake. So that's it. That's the first figure to go through there and calculate with regards to your group statement of cash flows. The dividend paid to the non-controlling interest that appears there within your financing activities. The second aspect to go through and consider now is looking at the dividend received from your associate. Again, old-fashioned me is going to go through there and calculate it using a T account. I will show you other ways to calculate it, but if you calculate it in other ways, you could come unstuck within the exam. Okay. So with the associate, how do we go through and account for an associate whereby we have influence and the power to participate? What was the type of accounting? Equity accounting. Excellent, well done. So we equity accounted for it, which meant that we had one line item in the SFP, investment and associate, and one line item in profit or loss and other comprehensive income as share of profit in the associate in profit or loss and share of other comprehensive income, wasn't it, further down. Okay. So what you've got is, if you think about it again as a T account, you've got your opening asset figure, isn't it, on the SFP. So that's on the left-hand side as a debit. The closing figure is there as the carry forward, ready to bring forward in the next period on the debit side. For now, we'll assume that there is no other comprehensive income. We'll keep it simple. If there were, obviously you would treat it in a similar fashion to the profit figure. If there is profit made by the associate, then what we've gone through and done there is that we've increased the investment in associate, haven't we, by our share of the associate's profit. So effectively we have debited the investment in associate and credited the statement of profit or loss. So that debit to the statement of financial position increases the investment in associate. So that figure comes from the statement of profit or loss. We would also include the other comprehensive income figure if there were to be any other comprehensive income to do with the associates. Okay. Once you've done that, nice and simple, balance things off. You've got there your dividend. So that there is your dividend received. So essentially it's the dividend paid by the associate, which is the dividend that you have received. So that's the dividend received from the associate that goes into your investing activities. Effectively, that dividend there should be P's share of A's dividend. So it could be that you're given A's dividend. It could be that you know your ownership in the associate. You don't even need to draw up a T account. You just need to put in P's share of A's dividend. Okay, and there you have it. So that's the T account. That's the background knowledge. There isn't a huge amount of knowledge to it that is required. Let's go through there and have a look at the example. Okay, so it says calculate the dividend received from the associate to appear in the group statement of cash flows for the year ended December, again, 2015. So again, you've got there your brought forward, and then is it your carry forward? So is it there 180 and is it 190? So I've got there my associate. The brought forward is there as 180. The carry forward is there as 190, wasn't it? What I need to find now is the profit figure. Okay, so what you've got there is you can see that one line item, share of profit of associate, which is there, is it as 20 through the statement of profit or loss. So you've got that figure there of 20. That's the profit figure. So when you balance everything up, you have, is it 200 on the left? You have, is it 200 on the right? The balancing figure, effectively it is that bank figure, isn't it? Which is there as 10. Okay, because what you've done is you've received money, haven't you? You've received money from the associate, so you've debited the bank and credited the associate. Again, that 10, whereabouts does it go? So remember, that is your dividend received from the associate, and that goes there, doesn't it? Like all your dividends received within your investing activities. Okay, so it's important not only to be able to go through and calculate the figures, but also to know where they go, because you could potentially be penalised if you calculate the figures and put them in the wrong place. So far we've calculated the dividend received from associate, the dividend paid to the NCI. Hopefully you'll find those that they weren't too challenging. The theory, the knowledge isn't that bad. It's when you get to the bigger questions that it does get to be quite challenging, because you've got all the other elements of cash flows appearing that you've seen in F7 with some complicated P2 aspects on top of it. I'll see you all in the next session when we begin to look at the acquisition and the disposal of a subsidiary in a little bit more detail. Other than that, I'll see you all then.